SPLG is often described as one of the lowest cost ways to own the S&P 500. That description is accurate, but it doesn't explain why the fund exists or how it's meant to be used. SPLG is not designed for timing, trading, or complexity. It's structured to deliver long-term S&P 500 exposure with minimal friction. For investors using the S&P 500 as a core holding, those structural choices matter more over time than short-term price movements. SPLG is State Street's low-cost S&P 500 ETF, built for long-term buy and hold investors. Its role is not to beat the market, but to deliver the market with minimal friction. The fund seeks to achieve this objective by holding the constituent stocks of the S&P 500 index, weighting each company based on market capitalization, and making adjustments when the index composition changes. Market capitalization weighting means that companies with larger total market values represent a large portion of the fund, while smaller companies within the index represent a smaller portion. Because SPLG follows a passive strategy, portfolio turnover is limited. Holdings change primarily due to index rebalancing, corporate actions, or changes in index membership. This approach helps keep costs low and tracking error relatively small. Before discussing SPLG, it's important to understand what the S&P 500 index actually represents. The S&P 500 is an equity index composed of approximately 500 large capitalization US companies, and they're selected using defined criteria, including market capitalization, liquidity, sector representation, and financial viability. Its purpose is to measure the performance of the US large cap equity market, not the entire economy, and not all publicly traded companies. The companies in the index operate across a broad range of sectors. Because of this breadth, the S&P 500 is widely used as the primary benchmark for the US equity market performance. An exchange-traded fund, ETF, is a regulated investment structure that pools capital from many investors and allocates it into a defined set of assets. For equity ETFs, this typically means holding shares of publicly traded companies, selected according to an index or rules-based methodology. ETF shares trade on public exchanges throughout the day, with prices reflecting both market supply and demand, and the value of the underlying holdings. By purchasing a single ETF, an investor gains diversified exposure across many securities at once, rather than relying on the performance of any individual company. SPLG was created to serve a specific shift in how investors use S&P 500 exposure. As index investing grew, a growing share of investors began using S&P 500 ETFs as long-term core holdings, rather than short-term trading instruments. These positions increasingly sat inside retirement accounts, model portfolios, passive allocation strategies. For this group, the priorities were different: minimize ongoing costs, reducing structural and operational friction, and maintaining consistent rules-based market exposure over long horizons. This created demand for an S&P 500 ETF optimized for long-term ownership, rather than frequent trading. SPLG was built to meet that demand. Its objective is straightforward: deliver broad S&P 500 exposure while emphasizing expense control, operational efficiency, and close index replication. The fund is structured to track the index reliably while keeping ongoing costs as low as possible for investors who intend to hold it for many years. Its design prioritizes simplicity, predictability, and long-term cost efficiency, characteristics that matter most when an ETF is used as a foundational holding rather than an active trading tool. Expense ratios matter because they're not the only cost investors pay, regardless of market conditions. An expense ratio is the annual fee an ETF charges to operate the fund. It's deducted internally from the fund's assets, which means investors never see a bill. They see slightly lower returns instead. The fee is charged every year, so it compounds. Because expense ratios compound negatively, even small differences persist over time. For investors using long-term, passive strategies, expense control is one of the few variables that can be managed with certainty. This is where SPLG's design matters. SPLG is structured as a low-expense S&P 500 ETF for investors who intend to hold their position over extended periods. Lower ongoing costs reduce structural drag and allow more of the index's returns to remain with the investor. Individually, the difference may appear modest. Over decades, it becomes permanent. SPLG is built as a passive index tracking ETF, with the design optimized for long-term ownership. SPLG follows a rules-based methodology, tied directly to the S&P 500 index. Holdings change only when the index changes, or when corporate actions require adjustment. There is no discretionary security selection, and no tactical positioning. Fewer internal decisions mean fewer sources of unintended deviation from the index. Cost control follows naturally from this structure. Without active management, frequent turnover, or tactical overlays, ongoing operation expenses remain low and predictable, which is a key consideration for investors holding the fund over long horizons. SPLG also uses the standard ETF creation and redemption mechanism. Shares are issued or redeemed based on market demand, without requiring the fund to meaningfully alter its underlying holdings. This supports price alignment with the index and allows the fund to scale efficiently as assets grow. Taken together, these structural choices prioritize consistency, transparency, and efficiency. SPLG is optimized for consistent exposure rather than frequent trading or tactical deployment. SPLG is structured with a relatively low share price. In theory, share price doesn't change the economic exposure of an ETF. In practice, it affects how efficiently capital is deployed. When investors contribute fixed dollar amounts, a lower share price reduces the amount of capital that remains temporarily uninvested. More of each contribution is deployed immediately rather than sitting idle between purchases. A lower share price also improves allocation precision. Position sizes can be adjusted in smaller increments, which helps investors maintain target allocations without over or underinvesting. This matters most for investors who add capital regularly. Over time, small deployment gaps compound into measurable differences in exposure timing. SPLG's lower share price does not change risk or expected return. It improves execution efficiency, allowing contributed capital to participate in the index more consistently. Tracking error is the gap between what an index delivers and what an investor actually receives. For SPLG, it measures how closely the fund's return follows the S&P 500 index. SPLG is designed to keep that gap small. It uses a full replication approach, holding the index constituents at market cap weights and adjusting only when required by index changes or corporate actions defined by S&P Dow Jones indices. There's no discretionary trading intended to improve returns or time the market. Even so, small differences between the fund and the index still occur. They come from mechanics, not decisions. Operating expenses, dividend receipts and reinvestment timing, cash balances during rebalancing events. These effects are normal in passive ETFs and are typically measured in basis points. The important distinction is this: tracking error is not a short-term trading concern. It becomes relevant only over long holding periods. For investors using SPLG, the objective is not perfect day-to-day matching. It's consistent index delivery over time with minimal structural drag. That is the standard SPLG is built to meet. Liquidity determines how easily an ETF can be bought or sold without materially affecting its price. For SPLG, liquidity is sufficient for long-term investment use, but it's not specifically optimized for high frequency or tactical trading. On a day-to-day basis, SPLG's trading volume is sufficient for investors who enter positions gradually, transact infrequently, and hold positions over extended periods. Beyond on-exchange trading, SPLG operates within the standard ETF creation redemption framework. When demand increases, authorized participants can create new shares. When demand declines, shares can be redeemed. This process helps keep SPLG's market price closely aligned with the value of its underlying holdings, even when trading volume fluctuates. Practical implication is straightforward. SPLG is not optimized for intraday trading or rapid position turnover. It's optimized to remain liquid enough to enter, hold, and exit positions efficiently over time. For investors using SPLG as a long-term hold, liquidity is rarely a binding constraint. It becomes relevant primarily during unusually large trades or stressed market conditions. That distinction is intentional, consistent with how the fund is typically used. SPLG, like most equity ETFs, may make periodic distributions to shareholders. These distributions originate from the activity of the underlying companies held in the fund. Dividends. Dividends reflect cash payments made by the companies in the S&P 500. SPLG collects these payments and passes them to the shareholders according to its distribution schedule. Capital gains. Capital gains distributions are less common in passively managed ETFs like SPLG. Because SPLG follows a rules-based index and experiences limited portfolio turnover, securities are typically bought and sold only when required by index changes or corporate actions. In addition, the ETF structure allows shares to be created and redeemed in kind rather than through cash sales. This reduces the need to realize capital gains inside the fund. As a result, portfolio turnover is generally low, capital gains distributions tend to be infrequent, and tax efficiency is typically higher than in actively managed funds. The actual tax impact depends on whether the ETF is held in a taxable or tax-advantaged account, the investor's tax residency, and individual tax circumstances. SPLG's structure is designed to be tax efficient, but it doesn't override personal tax considerations. SPLG carries the same core risks as the S&P 500 itself. Because SPLG is built to closely track the index, it doesn't alter, smooth, or hedge the underlying risk profile of US large cap equities. The primary risks include market risk. The value of the fund would decline when the broader equity market declines. Equity volatility. Prices fluctuate over time, sometimes sharply in response to earnings, valuations, interest rates, and investor sentiment. Economic cycle exposure. Recessions, slowdowns, or financial stress can reduce corporate profits and compress valuations across the index. Sector concentration risk. The S&P 500 is market cap weighted, which means certain sectors can become dominant at different points in time. SPLG doesn't attempt to manage or mitigate these risks. It doesn't provide downside protection during market declines or tactical adjustments based on economic or market conditions. SPLG is designed to deliver market exposure, not to manage risk dynamically. Its role is to reflect the outcomes of the US equity market, both positive and negative, and as efficiently and transparently as possible. SPLG is optimized for long term ownership. It doesn't attempt to manage risk, rotate exposures, or respond to market conditions. Its function is singular and consistent. Deliver S&P 500 exposure with minimal cost and minimal ongoing intervention. For investors whose objective is ownership rather than activity, that simplicity is intentional.